You have probably tried a lot of buy and sell indicators on TradingView. Some are useful, some are not, and many of them only provide signals without much context. But the indicator I found does more than just generating buy and sell labels. It also helps identify dynamic support and resistance areas while providing insight into overall market momentum. I've tested it across different assets and timeframes, and it is definitely an interesting tool to explore. To add it to your chart, open the Indicators tab on TradingView and search for Pivot Point Super Trend. As you can see, it's one of the most popular indicators on the platform. Once you click on it, it will appear on your chart with its default settings. If you open the indicator settings, you'll find options such as the pivot point period, ATR factor, and ATR period. These values can be adjusted depending on the asset and the time frame you're analyzing. The indicator also includes several optional features, including support and resistance levels, a pivot point center line, and buy and sell labels. Depending on your trading style, you can choose which element you want to display on your chart. Now let's see how it works. In this example, the indicator generates a buy signal, and shortly afterward, price begins moving higher. While the signal itself may attract attention, it is also implying that market momentum may be shifting in the favor of buyers. As the trend develops, price pulls back towards the indicator line, which is acting as a dynamic support area. These pullbacks are often areas that traders monitor closely because they can provide additional opportunities to participate in an existing trend. Later on, the indicator generates a sell signal. Just as with the buy signal, this may indicate that market momentum is changing. Shortly afterward, price begins moving lower and the trend shifts direction. As the move continues, price rallies back towards the indicator line. However, this time the line acts as a resistance rather than a support. Price reacts from that area and the downtrend continues into the most recent part of the chart. Now let's look at how we can identify potential trading opportunities using this indicator across different markets and timeframes. One thing you'll quickly notice is that not every signal leads to a meaningful move. For example, in this case, the indicator generates a sell signal, but price doesn't move significantly lower. This would be an example of weak signal or a setup that lacked follow-through. One way traders attempt to reduce these types of signals is by adjusting the indicator settings. For instance, increasing the pivot point period allows the indicator to use a larger sample of price data, which can produce fewer but potentially more significant signals. As you can see, after adjusting the settings, that weaker signal disappears because the indicator is now focusing more on longer-term market structure. But regardless of the settings, there's something even more important. If you want to trade any indicator effectively, combining it with price action analysis is crucial. Many traders rely entirely on indicators, while ignoring what price itself is doing. Over time, this can lead to poor trade selection because indicators are only one piece of the puzzle. Let's go back to the previous example. I drew a support zone based on the previous trend base. If price had broken below that support level, it could have added more confirmation to the sell signal. However, price never actually broke the support. Now that means the indicator may have been signaling weakness, but price action wasn't confirming it. Without a breakout and a clear change in market structure, there would be little reason to consider a trade. This time we can draw a resistance zone using the major pivot points on the chart. Eventually, price breaks above that resistance with strong bullish candles. At this stage, price action is confirming the shift in momentum. Now, since the breakout is supported by the indicator's bullish signal, the overall setup becomes more convincing. After the breakout, price pulls back towards the former resistance level before continuing higher. Many traders watch for these types of retests because they can provide more structured entry opportunities. We can combine the pivot point super trend with a second indicator to build a stronger overall framework. More confirmation doesn't eliminate risk, but it can help traders build confidence in their analysis. Just remember that risk management and position sizing remain the most important parts of any trading strategy. For the second indicator, go back to the Indicators tab and search for Logarithmic Regression Channel Trend, created by Big Beluga. This is actually one of my favorite indicators. Once added, you'll notice that it serves multiple purposes. It acts as a dynamic support and resistance system, identifies trend direction through its channel structure, and provides momentum information through color changes. Let's look at an example. Price breaks above the channel's midline. Since that midline is acting as dynamic resistance, the breakout can suggest that momentum is shifting from bearish conditions toward bullish conditions. As price continues moving higher, the channel gradually turns blue, reflecting the strengthening bullish trend. What's especially interesting is what happens during the trend. Price pulls back towards the channel's midline, but instead of breaking below it, the market respects it as a support and continues higher. That means the middle line isn't just helping identify trend direction, it can also act as a potential area of interest during the pullbacks. Later, toward the end of the move, price breaks below the midline. If selling pressure continues increasing, some traders may view this as an evidence that momentum is shifting back to the downside. Shortly afterward, the channel turns red and follows the new trend direction, providing additional confirmation for the bearish shift. Now let's combine everything we have learned from these two indicators into a complete setup. But before we do that, if you have learned something new so far, make sure to subscribe and leave a like. It means the world to me knowing my free content is making a difference. For bearish setups, the first thing we want to see is a breakout below the regression channel. This implies that bearish momentum may be increasing. Next, the pivot point super trend should generate a sell signal. This can provide additional confirmation that the market direction may be shifting lower. Ideally, the regression channel should also be red, indicating that the broader trend is already favoring downside. From a price action perspective, we can identify a support level created by the previous trading range. Once that support is broken and price retests the area, it adds another layer of confirmation. For bullish setups, we simply look for the opposite conditions. Price should break above the regression channel, implying that bullish momentum may be building. The pivot supertrend should generate a buy signal, helping confirm the breakout. Ideally, the channel should also be blue, showing that upward momentum is strengthening. From a price action perspective, we want to see a significant resistance level broken, demonstrating that buyers have successfully taken control of that area. We can also draw a trend line by connecting the higher lows. As long as price continues respecting that trend line, the bullish structure remains intact. Some traders even use trend line breaks as one of their potential exit signals when managing a position. When price action, trend structure, channel direction, and indicator signals all align together, the setup becomes much more strong than just relying on a single indicator alone. Before you leave, I have to announce that I am not a financial advisor, and this is not a financial advice. All content, information, and opinions shared in this video are for educational and entertainment purpose only. Trading involves risk. Consult a professional before taking financial decisions.